Hey everybody, welcome to Trading Capital's Daily Analysis video. I'm your head market analyst here, Curtis Scouten, jumping into the charts on this Friday, October 7th. What a tremendous day it was today in terms of the sell side pressure, and were we not warning for this sell side pressure basically ever since we offloaded about 13 of our long positions? And even last night we put out a little alert to the chat basically saying that yields are about to break out. They broke out on the intermediate time frame as well as the US dollar broke out, which signified more likely probable upside for the dollar and yields, and that's certainly what we got. And did that put pressure on the markets? Yes, it did. Now, the significance with the confirmation of the breakout, what really triggered the move to continue and get the legs behind the dollar and the yields, was the fact that the labor market's jobs number came in a lot stronger than what people expected, which means that the people are now thinking that Powell is going to yet continue to be more hawkish. And that certainly is going to be the likely scenario. That's why it's so important to follow the charts, because we were warning of a technical breakout on yields, which we were positioned for carefully heading into this, and that's certainly what we got. Did I know the jobs number was going to come in hotter than expected? Absolutely not. But the way money flow works, money flow has the highest probability of being correct in most situations. It's very rare that the market is surprised and doesn't generally price something in before it happens. And that's, to me, the divergence in the bond market and the stock market. The bond market was signaling that we were going to have a strong jobs number, and that's what we got. So that's how we were positioning. It's all probabilities in this game, and that's how the markets work. They're always forward looking, and the price and rotation of money, which is what this chart is, will demonstrate the likeliest outcome in most situations. But let's look at the S&P. So S&P finished down 2.79%. You can clearly see a nasty sell-off on the S&P. If we zoom in here, this was your fake print that you got, and now we can finally chalk that off. We have filled that technical gap, even though this still changes the depth and the degree of the chart. From this would be a little bit more bullish because it shows a reversal, whereas this, if this was hollow gap, it would show a not as bullish because you gapped up, and generally gaps fail. But that being said, we've now filled that technical gap. If we even go to the intraday chart, your technical gap was all the way up here, 366. And the crazy thing is that you got your bounce before the gap, had a little bit of a pre-market bounce, and then you sliced right through that technical gap. Many people were sitting at that gap to basically play it for an intraday bounce, and it sliced right through that. You got your bounce. Basically, as it sliced through that, retraced back to that gap fill, and then the markets just created this tight range. And this was all algorithmic selling. The reason that you see this harsh dump right off the bat is because this is the highest volume of shares being exchanged in basically the first hour of trading. So when you get this opportunity for institutions to unload and dump, often the price overshoots quickly because there's so many shares being changed at hands. And then later in the day, the volume lightens up significantly, but then you can tell by the type of range that it's forming that this is just an algorithmic range executing a sell side plan based off of the adjustment of interest rates, based off of people adjusting to potentially a more hawkish Fed. So, and obviously the US dollar breaking out. But on a daily basis, let's just flip to the weekly. I want to show you an interesting chart. The fact that we confirmed the downside here, 1-2 weeks, boom, that break is on, signifying massive downside ahead. Now, look at this type of reversal. That is not a healthy looking reversal. When you go up to test this and you can't even make it to the retrace of the breakdown zone, that is never a good sign. And when you get a degree of a reversal of that magnitude, that just shows you these markets could be in a lot of trouble. And the importance of this green line over here, that is the downside move of our head and shoulders pattern that triggered. So this left shoulder, that head, that right shoulder. So it stands to suggest that there's a likely scenario we should now head down to this 344 and change level before we get the next bounce. And you can see that This will be a big pivot zone, multi-factor pivot zone, kind of your consolidation breakout. Obviously, this is still QE, so I do think we're eventually going to be heading back down to this level. But this is kind of your intermediate. I do think there will be a bounce from that level as long as there's not a major blow up or something of that degree. I'm still not seeing any signs of a crash in the bond market, which is kind of what I'm looking for to front run the equities and stocks. With that understanding in mind, massive technical down day, lots of damage done on the charts. Can we get a bounce still here at double bottom? There's a potential, but since that pattern triggered, I think maybe it's not going to be it's going to be a very short-lived bounce if we do get one from that technical level. Let's take a look at the QQQ. Obviously lots of technical damage as well, but the Qs did actually briefly, it's still holding its lows, but you pretty much came near the bottom of this level. So perhaps you can get an intraday bounce on Monday off of that level, but since we've now closed at that level pretty closely, that's not going to be a major support level in my opinion. Let me just take a look at the intraday. Yeah, this type of selling, I would not count on that level being a big major support level. Yes, you probably do get some sort of a bounce, but it's going to be a very small one, so to speak. I just want to do a check on the volume for the spiders. The spiders came in at 100.54 million. So yes, it was a pretty convincing sell-off today. Oil, interesting price action in oil. You know we are starting to short energy as well as oil and oil stocks. One of the reasons I'm starting to short oil is the price action has been exceptionally overbought in the short term. You've had a tremendous run off of the back of that OPEC plus, and even before that you had this little bit of a bounce and breakout, kind of a little two-day consolidation. You have fulfilled the upside of this consolidation. You're now into resistance. Yes, you have a short-term technical breakout out of this down-sloping channel, which does dictate that you should get a retrace back down, which should wipe away $5-6 off oil. Sorry, that would definitely help lower the shares of the energy companies that we're starting to accumulate shorts on, and pretty big ones might I add on, especially on like the likes of Exxon. But if you look at why we stopped at this level, if you simply draw a trend line over here, connecting, sorry, I'll readjust that, these pivots over here to this pivot zone over here to this pivot, you hit that level to a T. And then the third factor is, why did we stop there? Well, if you draw a trend line all the way across and you simply take the low of your harsh dump, that is your resistance level. In a way, you've retraced back to the breakdown zone. So this is why I think oil is going to head lower. Is you've had an OPEC cut, which you can argue that this has now been priced into the price of oil. Yes, it's ongoing 2 million barrels per day, but historically when you look at OPEC and why and when they cut, they're simply cutting in economic downturns, and often in most situations that economic downturn over and supersedes the cut that OPEC does. Now, could oil continue to go up and eventually touch this 200? It sure could, but you're at a technical overbought scenario in oil where this is your shot as a trader to look for that pull-off. And if we get a harsher sell, and from what I'm seeing across all markets, especially the home builders, real estate, basically every sector, the Dow, all of these sectors, utilities that use a large abundance of energy are starting to collapse and really roll over. I mean, if we look at the XLU, the downtrend, and we were warning via the XLU chart that the S&P is going to play catch up. And look at this beautiful confirmation, 3-bar surge to a low, and you've confirmed on a weekly basis the breakdown in that trend. So that is never a healthy sign. So if you take a look at this long QE trend, this is since money printing started, and now money printing, believe it or not, in September started rolling off the balance sheet. So you've broken this channel on a weekly basis, and now you've confirmed below it. Now that markets are in dire straits, in my opinion, this is a critical breakdown in one of the most leading and important sectors, utilities, and this is the defensive sector. So you are short-term oversold on utilities, so could you get a retrace back there? I think you could, but I highly doubt that we're going to get any meaningful bounce in the markets until we hit massive level on the S&P 500. The markets are not going to bounce unless the S&P hits a major technical level in a pretty much an oversold condition. So lots more downside could be coming in these markets since we are breaking. Markets could get a little bit of a bounce coming Monday because things are oversold, but this is the tricky part of the markets. And what I mean by tricky is that you are going to now start having these divergences between small caps, mid caps, large caps, and mega caps. And this is where the markets get so volatile and tricky, because you could have a Tdoc bouncing but an Apple falling, or an Apple rising and a Tdoc falling. But the certain small caps are at technical levels where I do think they're actually, believe it or not, a healthy long. For instance, if we look at Tdoc, and sorry, this video might be a little bit lengthy, but there's so much to discuss in today's price action. Tdoc is completely oversold. It was obliterated today. It was down 6.277%. So Tdoc, we were originally trading this channel over here where Tdoc was breaking. Now you've broken down and you have what seems to be confirmed a breakdown of this channel. Actually, you confirmed it last week, so this week is just another down week. But you broke that channel. And now what I think is likely going to happen is you've made a pretty defined low here to trade against where there is support. We could be slowly forming this new channel here, or you can see this downsloping channel where Tdoc can now trade from the bottom of this channel to the top of this resistance, from the bottom to the top. And since markets are slightly oversold and you do have a strong pivot zone over here with lots of accumulation happening in the last two sessions over here, Tdoc is at a pretty decent accumulation level where we still could technically bounce, even up to fill this gap. And these are going to be the important ranges as traders that we are going to identify starting this time around. That's a 10% range that we can trade, but the range will get bigger, but it will also start to tighten up. And just like we had a trading range here, we're going to identify a new trading range in Tdoc and start trading that accordingly, buying support and selling resistance. I want to show you AMD. AMD is another one we added to. It has just been taken to the woodshed. Obviously, they came out with lowering their guidance yesterday. You can see that it traded a massive amount of shares, the most shares since basically here in May. This candle right over here, which obviously was the peak of a little bit of a bounce, had a big sell-off and then another bounce. But nonetheless, AMD, one of the reasons, I was nervous, and when I get nervous, I know I still get nervous. You have to check your emotions when you're seeing the sell-off. But you have to be able to still buy the technical levels. Even when you're nervous and the charts are saying buy, you have to put that nervousness aside and buy, because most situations, the charts are going to be right, and that's all we care about. And you start getting into issues when you start listening to your emotions and you don't buy. You say, okay, this time I'm not going to, but the chart is saying buy, but I'm not going to because I'm nervous, my emotions. That's what gets you into trouble, and that's what wrecks investors and traders' probabilities of being correct, because you can't start picking and choosing when you want to. Yes, you can use your guidance and your overall market insights, just depending on how things are. But when you have a quality company, yes, they've been lagging the sector, but you have a down day today of 13.87%. We were slightly in the money not too long ago on this trade. Up until today's gap down, it put us out of the money. And we actually added twice to AMD. So we greatly increased our position. We added at this technical gap window over here today. And then we also added basically right at this pivot zone over here. What was it, 58? I'll have to check my my level, but it would have been 58.51. Now you have come down slightly in the after hours, but when you have a parallel channel connecting your major pivot to your pivot low, you kissed it, to another pivot low, to this kiss zone here, kissed it, all this chop, you never confirmed above, and then you've pretty much had a straight sell-off from 104 all the way down to 58. That's almost a 50% drop in AMD. And when you look at the long-term picture that you're at this technical pivot zone, you filled a massive gap. It is oversold on high volume. AMD could have a bounce even back up to this gap fill around 67, which would I look to unload? Yeah, maybe so. But This one, you know what, I don't mind being slightly out of the money and holding. It is a better company, and we'll just have to, we still have a little bit of room to add if it goes lower. There's always that potential, but even if we look at the weekly level, you know, this is a massive technical level going back to 2010 pivot, another pivot action, your 2018 pivot, basically your COVID crash over here, chop zone, breakaway, and you just hit that today. So again, these are the levels, 4 weeks of downside, you fulfilled this bear flag move, you're into tons of support, massive trend lines. You have to take your shots at some levels, and this is why I didn't, my emotions are saying don't buy, but the technicals are saying buy, and this is where I'm listening to the charts instead of listening to my emotions. If we take a look at natural gas, sorry I'm a little bit all over the place, it got a little hit down on the day. Obviously oil was taking a lot of that money, that energy money, my apologies. Let's just take a look at gold. First we'll touch base on the dollar, the DXY. So if we take a look at the DXY, and let me go to the 4-hour chart because that's what we were analyzing earlier, and I did that in yesterday's video. The DXY, like I said, we were looking for a retrace to this orange breakdown. This was your head and shoulders mini topping formation on the DXY, which triggered, you fulfilled your downside, and then generally you get a retrace to the scene of the breakdown, which is what you got. But the importance of this is, like, are we going to close and confirm above this neckline? If you do, then this topping formation is negated, and it's likely we go test the double top zone of the dollar. So that's why it's very critical, and that's why I was expecting downside, because certainly the charts were showing that the dollar was potentially breaking out again. Even if you take away, you know, so obviously in 2 hours we'll know if the dollar closes above that neckline, then it's likely we head to 114, which will be certainly put a lot of pressure on the markets. But even if we take away that orange line, you can see this down sloping trend line. The dollar broke out, had basically that fake print which gapped it lower, and then it rallied up to that fake print zone which we warned everyone about, which was over here. This was your fake print. And then you confirm the technical breakout on the daily basis, which just got more confirmation this week. So the dollar is clearly seeing signs of strength again. Next resistance point will be around 114. If you get through 114, then you're looking at 114.87. Might I be clear? There's always a potential that the dollar can break out of this channel and head to 120 on some sort of a blow-off move. There's always that potential. We have to keep that in mind for sure. So if that happened, where would these markets be? Maybe that's what takes these markets lower to the next down leg, is some sort of a blow-off top in the dollar. That really sends, you know, a blow-off top in the dollar would likely occur with some sort of a crash in the stock markets. That's generally what happens, is you start to see a crash in the stock market, and then the blow-off top would naturally begin as people are hitting the sell button, sell button, sell button. So we'll just have to continue to watch the dollar and see how that progresses, but clearly that's everything to the markets. Also the 2-year yield, let me just pull that chart up. So the 2-year yield, once again, also almost confirming a breakout. So again, if we look to the 4-hour chart, and sorry this chart's a little messy, I have a lot of intraday analysis going on. Let's just clear those off. So if we look at the 4-year chart, we were watching this technical gap fill over here. We said the gap is likely going to pull this up, but the big level that we had to get through was this yellow trend line. Just like the head and shoulders on the dollar, this has a mini one, and it's not really a left shoulder, but it is a sort of topping formation which you can use as a guide for your support and resistance. So this topping formation played out to the downside. You got your bounce. The type of retrace we wanted to see was critical. We warned in our videos that you would likely get a retrace, bounce off of that, and then the type of consolidation you wanted to see was this tight range, and that's what you got. You got a surge and a breakout in the 2-year yield, and it just kept on going, going, going. And look at this, you almost hit a double top on the 2-year, which makes me think that there could be more upside in the 2-year to this 4.443. That's my next level that I've calculated out, and I do think we could see some sort of a little bit of a surge in the yield as well. And the 2-year yield implies the level of hawkishness that the bond market is seeing in the Fed. And basically the 2-year yield right now is saying the Fed fund rate has to get to 4.31%. So this yield is the most important because this is what the stock market prices it off at. Yes, the Fed fund rate is lagging. It always has been and always will be. The 2-year yield is forward looking, and that's what the stock market reprices to. So any type of movement in this will certainly put pressure on the overall stock market. Let's take a look at gold now because gold's pretty key. Despite the hard selling, gold did not really sell off. You still have your downsloping channel over here. You are at resistance, which you're actually doing beautiful consolidation. This is actually healthy consolidation. We really, the key level that you want to hold for gold is basically in between this 1695 and 1676. Obviously 1676 is the low. You do not want to see gold take this level out. If gold can still consolidate, kind of holding and hugging this lower boundary range, then gold will likely be primed for a move up. And this would obviously coincide with potentially the dollar falling. I don't think gold would get any sort of a bid unless the dollar fell. But considering the dollar rose substantially, gold really didn't fall too much, considering also how much the market was falling. Silver, I was so close to picking up some more silver today, but I decided to be a little bit more patient. Obviously with silver, you have had the breakout confirmation, but the markets are so weak right now with potentially yields getting one more spike in the horizon. I decided to wait on picking up more silver. I want to get a healthy level, a retrace basically to at least this first level here, and hopefully the second, this 1935, give or take a few pennies. But I do think that if we're patient enough, silver should retrace, and I'm certainly hoping for that. Pan American Silver is the other one that I almost picked up today, but we did not get that clear retrace. So basically, we sold our PAAS over here at 1691. Our average was 1560. What I'm looking for on Pan American Silver is there's so much strength in the silver, but if we get it, since the price action did not retrace all the way back down to this breakout zone here today, what my mind is naturally thinking and assuming is that now we're going to get a retrace and fill this technical gap. If we get a retrace down into this gap fill, you better believe I will be buying Pan American Silver and loading in a heavy position. So that's kind of my overall thesis on the silver industry. But we did close a couple trades today. CVS, that was a beautiful one. Obviously we are shorting Exxon, so XOM is just been crazy. I mean, let me just clear this chart off just to clean it up. But Exxon basically has come into this double top zone. Look at this surge. 1, 2, 3, 4 bar surge. You had a fifth high today and you reversed off the highs. That is your little bit of a reversal signal. Also considering that there was a decent amount of volume on Exxon, and basically you came into this double top zone over here, which is proving to be resistance. So the key thing that I see on this chart is you've now filled all the technical gaps to the upside, as opposed to you now have to fill all of the technical gaps to the downside. So what I mean by that is you have a gap fill here, you have a gap fill here, you have another gap fill here, you have another gap fill here, you have a gap fill down. Oh, nope, that one. You have a gap fill down here. There's so many gaps to the downside that make me think Exxon is going to be having some sort of a consolidation and pullback. And if you look at the larger time frame, the monthly, these charts are notorious and epic for sucking in new money. It's just like what oil did. And considering how high Exxon is trading in comparison to the price of oil, it's crazy the overall overboughtness. So again, if you see that level, your pivots to your pivots, and look where you are. But the fact that you have this beautiful monthly reversal signal as resistance, it's a pretty defined top. And when you start seeing this reversal signal and then your wide range red bar, all of this new money is just being sucked in for what I believe is going to be the next sharp down leg in the overall economy and the overall energy price. If anyone studies energy, how they react in times of economic decline, I mean, look at this. You start getting these choppy moves, boom, choppy moves, because so much money is trying to flow into the energy sector. It gets so overcrowded at some point, and then the economy breaks. You know, same thing. You had your COVID collapse. You had your interest rate tightening cycle here where the markets went through a taper tantrum. You had your COVID collapse over here. So energy can start moving, but when you start seeing these choppy formations where market is falling fast, rising fast, falling fast, rising fast, near the highs, you better take note, because look what the price action looks like. It starts chopping, very, very volatile, very sharp moves in either direction. Is never a healthy, sustainable type of price action. And I think at the minimum, I think Exxon, the big level that we're going to get a retrace to, is basically to your previous high here in 2014, which is 72. That's going to be an epic level to buy once it does fall there. So I do think I'm very comfortable holding this right now. It does seem that we have the reversal in place and that the down move can likely start occurring. So that's kind of what I'm expecting. But overall, pretty tremendous day today. Once again, our accounts took a little bit of a hit with some positions, but we were still, I mean, beautiful trades on the marijuana. If you just see, like, oh my goodness, talk about a round trip experience. Oh my, you know, good thing we sold here. But now look, the crazy thing is, here's the thing. The crazy thing with the cannabis sector is that we are now own CGC even cheaper than when we did before we just sold it yesterday. So that's the type of opportunity we just got. And CGC, I still like these levels. This is forming a beautiful basing formation. And honestly, the type of investment that CGC is, you got to leave yourself accumulation for a range of at least, 30 to 40%. But when these things do bounce, they bounce tremendously. And I still see accumulation occurring at these levels. Despite the fact that you got a nasty reversal signal, you're still holding the support zone. This is just a pretty much an ample buying opportunity. And even if we crash through there, will I continue to accumulate at these lows? Absolutely I will. When you look at CGC and you're still holding this major parallel channel, and then you have a secondary downsloping channel of resistance that you're looking at here, and then you also have this downsloping channel and range to trade in. These are the levels where this is putting in a basing formation, testing your resistance. Usually in a basing formation, when you come up near resistance and fail, and then you shoot up to again and hit it, you've now weakened this downsloping trend line tremendously. And what I mean by that is the next big push up in CGC, I think will likely break through this downsloping channel. And when it breaks through this downsloping channel, that's when you see a short squeeze of an epic proportion. So this little move, and this is why we shorted it yesterday too, day trading, is because you hit right into this resistance, multi-factor resistance. The first time you hit this downsloping channel, you're likely not going to break through. But the next time, I think we could get a breakthrough. And now look at this wedge you're just trading in now. So it'll be interesting to see if we can hold this. If it holds this, I may look to even just increase our exposure in CGC. And this could be a play that diverges from the overall S&P 500 and some of the larger cap stocks, even in a down market. So let's just, obviously today it got creamed down minus 25%, but it's not going to have days like that all the time. And it's just thankful that we traded this correctly, selling into strength. Boom, round trip, basically back in CGC again. So, and we will take our profits any day of the week. But lots of opportunities moving forward. There's a tremendous amount of risk. But overall, I think we are positioned well. We are also shorting Bitcoin. So believe it or not, Bitcoin is now what I'm watching for 3 hours and 19 minutes. Do we confirm back below, do we close back below this yellow 2017 pivot? If we do, that is extremely bearish in the short term. So honestly, our big level that we're just playing is this previous pivot high. That's your massive technical support. If you close back below that level, price action moves to the bearish side tremendously. You can see we're slightly out of the money on our short, but I do have a tight stop loss at this 20,191, basically risking 3.5% for potentially a big sharp move down in Bitcoin. If Bitcoin closes, you could see fireworks at or below this level in 3 hours and 19 minutes. You could see fireworks over the weekend for this type of price action, because the biggest moves come from failed patterns. So here, you obviously failed the breakout, and look, you had a sharp move down. Here, it looked like you're breaking out, people assuming that you're going to have a big move up. it could lead to a massive move down if you have this failed, yet again, attempt at breaking out. Look at the previous attempts at breaking out. Let's just go back at it. Here, you failed to break out, big sell-off. Here you came up close, big sell-off. Here you came up close, big sell-off. Here you came up close, big sell-off. Now here again, you're testing it, and the longer you can't break out, the higher chance of having a big sell-off. And it just starts with this, multi-day consolidation, and then boom. Even sometimes you don't have that massive consolidation, you just have a big move down. So the longer this starts to meander sideways and lower, that's not healthy price action for Bitcoin. So, but the importance is we're still on a knife's edge here, and in 3 hours and 18 minutes we'll know more with this daily close, but we are short Bitcoin at this point in time. Tight stop loss just in the event that it pops on us, and then obviously if it starts falling, then the downside levels we start looking towards are much lower. I mean, we could see a pretty sharp sell-off down to 14,000. I think you'll get a bounce here around 16, just depending on how fast we get there. But you're talking about, your major pivot at 14, and then a big level is this one, this triple top. You have this high here, this high here, this high here, and this was basically your QE money. This is basically when the money printer started at 120 billion a month, and you can see the trajectory Bitcoin went in. So this level is going to be very important too, this 10.5 level. So again, lots to digest. Sorry this video is longer than usual, but there's so much to cover moving forward. We really have to be careful on how we position ourselves. But I wanted to get some more short exposure just due to how the markets were breaking down. You can see that with this overall topping tail on COP, we also managed to short it at the highs. One of the reasons is you had this breakout, but then you had this right into double top overbought scenario. If you flip to the monthly chart, you can see this beautiful channel that we're trading in, a low to a high to a low to yet again a high, and that same sort of monthly reversal signal on volume will keep this market in check in more situations than not. I love this pattern where you have this harsh sell-off, you have all of this new money being accumulated in, it's looking like it's going to be a bullish breakout, and then the people that unloaded and forced this type of sell side pressure. And let me just be clear, there's not many people that can cause a reversal like this followed by a massive dump like this. This is maybe a handful of institutions who have the majority of the shares, sucking in the retail people, making energy so bullish as they're ready to dump and offload. I think that is what's going to happen based off of the technical signals and based off of how funds have the most type of money, and retailers are generally the ones buying up, which is what the media is saying, buy energy, buy energy, buy energy. And I do think we're going to get a harsh slam down just due to how this is still technically inside bar bearish consolidation over a period of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks. Let's take a look at oil, how long it took oil to break down from its inside bar bearish consolidation. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks. And then you got the big sell side move. So isn't it kind of ironic? Let's just see if that shapes out to be a very similar thing. We also shorted Hess as well. Why? Same sort of price action. So all of these energy companies are into massive monthly support, resistance, my apologies, and you generally see a big reversal, especially as economic conditions are deteriorating, and especially since all of the leading data and leading sectors that require the most amount of energy are also falling dramatically. So energies are notorious for being the last ones to fall in recessions, but the fastest to catch up and often supersede the decline and lead the decline lower once that energy momentum to the downside begins. So no question in my mind, we are overbought. We should see somewhat of an energy pullback just due to how extended we have been. So that's it for today's analysis and video. Hopefully everyone was able to play it safe and trade it safely today. Obviously we closed a few winners, which is nice to see, and I do think we are positioned well to benefit from the next volatile action, which is likely to the downside. So thank you all for being members. Please give this video a big like down